Hey everyone, Nice stock is down over 46% off its high, and in this video I'm going to argue why I think this is an excellent undervalued growth stock to buy. Now Nice provides digital customer service and connection between businesses and customers, along with some other features as well. And I think this segment is ripe for growth as businesses worldwide look to make closer connections with their customers. So let's take a look at the company's revenue growth, its profit margin, its cash flow, its prospects for the future, and then weigh it all against its valuation as my justification for why I like the stock and why I rank the stock as a buy.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so as I mentioned, the stock price is down over 46% off its high, 46.47% to be precise. It's down significantly. It hasn't been off this much since one point in time in the last 5 years, 3 years, I should say. And for the better part of the last 3 years, it's been trading at a higher valuation than it is right now. Now, if you look at the revenue growth for this company over the last trailing 12-month period in the last decade, it's grown nearly 4x, up from a little over 600 million in 2015, all the way up to over 2.465 billion in the most recent trailing 12-month period. Looking at its operating profit margin, you can see this has expanded and it's at record highs, 18.79% in operating profit margin over the trailing 12 months. That's up from around 9% in 2015. I appreciate when companies demonstrate dual-sided growth. What do I mean by that? I like when companies, as they grow revenue, they also grow their profit margin. That demonstrates to me they're getting better at doing what they do. They're learning how to serve their customers more effectively and more efficiently, and thereby driving increasing profit margin. It's less impressive when a company grows revenue, but it leads to bigger losses on the bottom line. That just demonstrates this company is chasing after growth, chasing after sales, and not paying any attention to getting better at serving the customers, getting more effective, getting more efficient. So I'm not too impressed with that. But when there's situations like what Nice is demonstrating with growing revenue and growing profit margin, that's something I consider investing in, which is why one of the reasons why I like Nice stock. The cash flow from operations to sales is not demonstrating that same type of expansion in operating profit margin. Although it is higher than where it was in 2015, it's been more volatile, and 25.19% in the most recent trailing 12-month period is up from a little over 12% in 2015. Now, there's a difference between cash flow and profit, and the difference is in the way things are accounted for. On your accounting statement, if you pay your employee, for instance, in stock-based compensation, that's an expense you have to account on your income statement, but on your cash flow statement, that's not cash leaving the company. So it's not a negative on your cash flow statement. So there's a variety of differences between your income statement and your cash flow statement, although over the longer term, they converge. So for 3 years, you might demonstrate big differences in your cash flow and your bottom line profit, but over a 10, 20-year period, these results tend to converge because eventually things need to match up, right? You can't report profits without reporting eventually the cash coming in from those profits. In the short term, you can report profits without having the cash. For instance, you can make a sale on accounts receivable. That company will owe you and pay you back in 30 days, 60 days, or 90 days. But eventually you will get that cash and it'll turn into cash flow. So in the short term, there are fluctuations between operating profit and cash flow from operations. That explains the difference here with Nice. Now looking forward, the company is forecasting 2.725 billion in revenue for fiscal year 2024. and it's forecasting earnings per share of $10.63 at the midpoint for the full year. So that would result in 15% revenue growth and 21% in earnings per share growth at the midpoints for both for fiscal year 2024, which is solid growth, especially when we compare it with its valuation, which I will share with you towards the end of the video. Now, if we look longer term and we look at the Wall Street analysts that are following NICE, they forecast that this company will grow earnings per share by 14.27% per year over the next 5 years. The current year, they also expect 21% earnings per share growth. They tend to agree with what management is forecasting for earnings per share growth in their current fiscal year. And then they forecast the earnings per share declining over the next 5 years, but still 14.27% is solid. It's faster growth than the average company in the S&P 500, which is forecasted to grow earnings per share by about 11.3% over the next 5 years. So NICE is going to grow ahead of the market it's operating around. Now, I highlighted I would share with you the valuation, which is the cheapest it's been according to the forward price to earnings ratio. NICE is trading at a forward PE of 13.9, which is relatively cheap when compared with the earnings per share forecasts, the cash flow from operations, the operating profit margin, and the revenue growth this company is demonstrating. So according to these valuations with these prospects, I think this stock is among the ones I recommend as a buy, as I've highlighted here. Now, of course, with any investment, there are risks, and no investment is without risk. So it's not unlike NICE does not have risks. It's just I feel the rewards outweigh the risks in this investment. One of the primary risks for this category is competition and the impacts that artificial intelligence will have on NICE. Companies are developing AI chatbots that could serve a similar purpose that NICE serves. So that has brought down valuation. It's one of the factors that has brought down valuation for NICE. But not all companies are going to want to use AI. And some of the chatbots that I've seen so far and that I've interacted with so far using artificial intelligence are very ineffective. I would say I've been extremely disappointed in the chatbots I've interacted with, mostly that are just artificial intelligence with no human intervention. And so there's still room for this category, for humans in this category, although maybe there's a chance that AI will improve to such a degree that humans will no longer be needed in this process. So there is significant risk. However, I think the risk versus reward is worthwhile at current valuations. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.